Good morning, everyone. Welcome to the Openpay Limited Investor Conference call. My name is Michael Eidel. I'm the CEO of Openpay. Joining me today is Andrew Burns, our CFO. Thank you very much for making the time to attend today's quarterly business update call for the period ended 30 June 2020. We have two sections to the formal part of this call, which will include a business update from me and a financial update from Andrew. If you have a question, please use the Q&A button at the bottom of the screen, and we will answer them at the end of the presentation. I will comment in my part on three aspects. First, our business performance along our key metrics. Second, our funding position. And third, our achievements on our growth investment strategy. Starting with our performance during the June quarter. Despite the far-reaching global economic slowdown due to COVID-19, which unfortunately isn't over yet if we look at the recent lockdown in Melbourne, we maintained a very strong momentum across all key operating metrics during the June quarter. We are immensely proud that we have been able to announce a new record again in active plans, active customers, and total transaction value, or TTV. Relative to the prior corresponding period, active plans increased by 229% to more than 825,000, and active customers increased by 141% to around 320,000. TTV grew to 192.8 million for the full year, up by 98.2% compared to financial year 2019, and up 119% for the quarter. In terms of active plans, increases were particularly strong in retail and our UK business. It's encouraging to see that the percentage of repeat customers continues to increase and has been at 70% by the end of this quarter. 48% of new plans were generated by existing customers during Q4 FY20. 42% of our customers have concurrent plans with us, solidifying the trend of them making it their habit to use our Buy Now, Pay Smarter product to manage their cash flow. In terms of active customers, we have seen a very strong increase, particularly in the retail vertical and also with online channel usage. Open May, our flagship month of merchant promotions, has demonstrated customers' positive response to our direct marketing and has been an exceptional success. Across our verticals in Australia, we have seen a continued change in business mix due to the impact of COVID-19. E-commerce remains strongly growing and contributes now 39% of our Australian plane originations. E-commerce has picked up strongly in early FY20 and has continued to accelerate into Q4, reaching over 400% year-on-year growth. Very positively as well, in-store business has also been growing year-on-year across our verticals and in spite of far-reaching lockdowns in Australia in Q4. Toward the end of the quarter, particularly the essential services in automotive, like car repairs, and healthcare, like dental treatments, which by the nature of the business happen mostly in-store, have picked up again. This provides us with a great opportunity for further accelerated growth across both channels. For active merchants, growth for the March quarter was 52% relative to the previous corresponding period, and we had notable additions across all industries. Due to the impact of COVID-19, a number of merchants who we have signed agreements with have postponed their in-store integrations of our product, which has reduced the growth rate slightly from the previous quarter of 63%. Towards the end of June and into July, many in-store integrations activities to enable merchant trading have been taken up again or completed, such as for the Just Group with their hundreds of stores. Increasingly important for growing our business at scale are partnerships with business platforms. We announced the agreement with Pentana in the automotive vertical in Q3, which will get us up to 1,900 new car dealerships via integration into their Era Power software. Our teams have been working well together, and we remain on track to generate revenues during half one FY21. In Q4, we landed a similarly important partnership arrangement with the First Group in Australia, a booking platform for medical treatments, which will create Openpay brand awareness on the My Health First appointment booking site through landing pages and widgets that highlight how the payments can be spread over time with our product. Our integration project with Woolworth for our new Openpay for Business offering in B2B has not been affected by COVID-19. The integration is progressing well, with revenues expected during this half. We are very excited to launch this new product with Woolworth soon to support their strategic focus on B2B, and that it opens up a large new enterprise market for us. The potential for B2B continues to be significant, and our discussions with our large enterprise retailers are progressing well. The UK business contributed significantly to the company's strong operating metrics for the June quarter. The 187,000 active plans represent an increase of more than 100% quarter on quarter. TTV for the period went up by 88%. Active customers went up 95% to 109,000, both compared to 31st March 2020. 48% of new plans were generated by existing customers during Q4. The UK business, which launched in June 2019, continues to operate in the online channel only. The main merchant addition during the quarter related to the launch of Openpay into JD Sports e-commerce platform, which went live mid-May with our unique 3-month plan. Whilst early stage, we have seen significant growth in both metrics, newly acquired customers and TTV. We also signed Watch Nation and Aristocrat Clothing, as well as Rug Company and Murdoch, and they will go live in due course. With JD Sports being live now, we have progressed a number of enterprise merchant discussions in the UK, which we expect to see materialize in H1 FY21. We are now also very well funded with our first debt facility in the UK and have more cash available to push harder on the acquisition of high-volume enterprise merchants. Further, we are working on the credit authorization process with the FCA, also expected to provide us with more flexibility of revenue generation and longer plans where applicable. We have also started to build out a pipeline in our verticals, which we will explore more systematically in FY21. So overall, a strong opportunity in the UK to accelerate growth. This leads me to my second point, our very strong funding position. Our funding is stronger than ever. In early June, we secured a new debt facility to provide growth funding of £25 million for our UK Buy Now Pay Later business with Global Growth Capital. This provides us with so much more balance sheet strength for merchant acquisition in the UK, as we do not rely solely on cash anymore to fund our strongly growing receivables book. Soon after, in June, we announced also a private placement following substantial inbound interest from high-quality Australian institutional investors. Under the strongly oversubscribed placement, we raised around $33.77 million at $2.40 per share, a 50% premium to Openpay's IPO price at $1.60 in December 2019. This strong recent debt and equity funding provides significant validation from sophisticated investors that Openpay has an important role to play in the consumer payments ecosystem, despite challenging market conditions. We now have a very strong balance sheet in place, which provides us with ample funding to support the delivery of our current strategic growth plans. Thirdly, here are some comments about the achievements we have recorded toward our growth investment strategy. First of all, our people. After we had reduced the capacity of our team in March when lockdown happened to preserve cash in very uncertain times, we are now so pleased to have the team on board again to continue supporting merchants and customers in this challenging environment, accelerate merchant onboarding, and drive further product innovation. As our headquarters is in Melbourne, we follow the strict regulations of the Victorian government and will continue to have the team working from home to keep people safe and healthy. The same applies to our team in the UK. I really want to thank the Openpay team for their loyalty and overwhelming support for the initiatives we had to put in place to ensure business longevity. In Q4, we soft launched our modified Buy Now Pay Smarter product in the new education and membership verticals. We already have around 24 merchants across the two categories. Interest from sport clubs and associations has been strong, although sport clubs have by and large paused trading during COVID-19. Even more encouraging has been our initial uptake in the education vertical, e.g. with entrepreneurs organization, MP Training and Recruitment, and Digital Picnic. We have some big organizations in the pipeline. Acquisition of one or more of them will lead to the official launch of these verticals in H1 FY21. Ease of integration is a major driver for merchant acquisition. To my next point. In Q4, we added integrations with leading platforms in the retail vertical, such as e-commerce platforms BigCommerce and Hybris, and in-store POS system Futura for POS. These integrations extend Openpay's possible reach into thousands of additional merchants in Australia and the UK. Important to our funding strategy with multiple debt providers, we have established flexible special purpose vehicles to accommodate additional funder-specific debt covenant requirements across the company's industries and geographies. This was instrumental in the successful securing of our agreement with Global Growth Capital as our first debt funder in the UK. Last but not least, we have also introduced advanced analytics capabilities to enhance our credit risk decisioning. This has enabled the targeted adaptation of credit rules in response to the continued challenges of COVID-19, keeping credit risk healthy and minimizing financial hardship. To conclude, we have been extremely happy with the performance of our business in Q4 and feel particularly encouraged by the excellent growth rates of our leading indicators. I will now hand over to our CFO, Andrew, who will discuss our financial position in more detail. Andrew, over to you.
Thanks, Michael, and good morning, everyone. This morning, I'll focus on key financial drivers of total transaction values, revenues, bad debts, and our available funding. As Michael said, we've maintained strong momentum across all of the key operating metrics in the June quarter, despite the current global economic conditions, which has been really pleasing to see. Our total transaction value for the quarter was a record 62.6 million, up 119% versus prior corresponding period. This sees us ending the year with total transaction value of 192.8 million, up 98.2% for the fiscal year. As expected, over the quarter, the transaction values for the retail vertical has grown faster than other specialised verticals, driven by new merchants in Australia and strong growth in the UK business, which is currently only focused in retail. Pleasingly, despite lockdowns and the current economic environment, the auto and health verticals have continued to grow total transaction values compared to fourth quarter FY19. In Australia and New Zealand, we continue to observe a shift in channel usage, with online business currently contributing 28% of total transaction value and 39% of the plan originations versus 9% and 14% respectively for the same period last year. The UK business remains 100% online and is growing strongly with the addition of new merchants such as JD Sports. From a revenue perspective, we've continued to grow our revenue, resulting in 18 million for the full fiscal year, up 64%. In the fourth quarter FY20, revenues are lower than the third quarter, primarily due to an accounting adjustment with the first-time application of AASB 9 in the UK business, deferring the revenues that have already been received in cash and have now been deferred into the FY21 year. The revenue mix and resulting gross revenue yields continued to change, reflecting the underlying mix of our total transaction values by vertical, plan lengths, and average transaction values. In the fourth quarter, gross revenue yield remains strong at 9% and continues to trend between the 9 and 12% based on our product mix. The current shift in mix has had a positive impact on the velocity of our cash collections, increasing our average turnovers of receivable balances to 4.6 times for the quarter versus 3.5 times in the prior corresponding period, with an average of 39% of our opening book being collected in the current month. This is driven by continued growth in both Australia and the UK retail verticals with shorter plan lengths on average compared to our other specialised verticals. Credit quality and bad debts. Pleasingly, the rolling 3-month net bad debt as a percentage of total transaction value is down to 2.9% for the quarter, compared to the 4.7% reported in the third quarter. This is also down from 3.6% in the fourth quarter of FY19. The enhancements to our internal automated risk management system and the inclusion of the additional third-party fraud solutions in March have had an immediate impact on the overall loss exposure. The financial impact of the enhancements are expected to continue as the systems are further enhanced and refined. Cash and funding. In terms of our balance sheet and funding position, we have $70.1 million of cash at bank with undrawn debt facilities of 45 million in Australia and 20 million pounds in the UK. In June, as announced to the market, the business successfully secured the UK debt facility for 25 million pound and completed the institutional placement for new equity of $33.8 million. The business is well positioned with a strong balance sheet and available debt financing to continue our growth trajectory through FY21 and beyond. With that, I'll hand you back to Michael.
Thanks very much, Andrew. So as you have heard, the June quarter has delivered strong results across all dimensions of our business and provides us with a very healthy basis for further accelerated growth in FY21. Strategic partnerships with enterprise retailers across Buy Now, Pay Later and B2B, integration opportunities into large business platforms with significant numbers of users accessible in one strike, if you like, further product innovation to engage our customers, and geographic expansion will set us up for the next level of scale and growth. We have now all ducks in a row, a very clear growth strategy, our differentiating technology and products, including B2B, debt and cash funding, a strong customer base, and our geographic footprint. All this and our availability across industries which matter to the lives of our target customers will come together to increase our growing position in this exciting new sector. On a more macro level, we have learned that this new Buy Now, Pay Later value proposition will not disappear. To the contrary, it has proven its potential to become the most preferred way people pay at global scale. As we continue to deliver consistently against our strategic growth drivers, we feel extremely well positioned to take a significant share of this huge market opportunity, adding value to our customers, merchants and consumers, and our shareholders. We look very much forward to keeping investors updated of our progress. We will soon release our full year results for FY20, which will also include some more details to our growth strategy into FY21. Thank you. With that, we will now enter the Q&A part of this call. Again, to ask a question, please use the Q&A button at the bottom of the screen. Good, we see questions coming in. Just wait another few seconds for you to give you the opportunity. I start, and just reading across it, I think there's some clusters of themes which you are interested in to hear from us. Maybe starting with Kirsty Kellu, with SIP and Afterpay in the market, what is your point of difference to attract consumers to your products? I think the differentiation is really across 3 dimensions. First of all, the flexibility of our products based on our very strong technical platform. We can offer plans which reach really from $20,000 to $20,000 and start with 2 months in the UK, even 1 month up to 24 months. And this flexibility, which is a product with no interest ever, is what our customers really like, the transparency and, if you like, the responsibility of the approach. The second differentiation is our availability in maybe different industries than some of our competitors. We are strong in retail, but we are also very strong in automotive, healthcare, and home improvement. And this is leading to the third differentiator, really the target customer base, which is more grown-up, finance-savvy people who like to manage their lifestyle and the associated budget smartly, based on our product across these different areas of their lifestyle, which is mobility with their car, the health of themselves and their family and their pets, by the way, and also their place where they live with home improvement, plus obviously retail for everyday requirements. That's our target audience, which we are proud to service well with increasing availability across merchant and industries. Another question, maybe taking it, a question from Jeff Dent. Are there plans to offer Openpay in the US and other countries in the future? If so, what countries, and is there a prospective date? Thanks, Jeff. Thanks, Jeff, for the question. What we have outlined in our growth strategy when we went for the IPO has been our first international footprint in the UK and growing from there, merchant-led, into some promising European countries. This is still our strategic approach for continued international expansion, and we are working on this project also with merchants into FY21 and following. The US, to get to this point specifically, we have obviously seen the highly attractive US market. It's a $4.5 trillion retail market only, and very compelling, obviously, for buy now, pay later as well as any other market we are already in. And we continue to observe and refine our strategy, what the best opportunity along our strategy and our differentiated approach would be to enter new markets. So more to come, and we are open for further opportunities as we move along. Just scrolling down to further questions. Maybe Mahmoud, take your question. Many thanks for the session information with the many competitors in the market. What is the impact of big buy now, pay later like Afterpay and SIP on Openpay market share? With Afterpay already increasing their in-store market, where is Openpay different market niche? First of all, thanks, Mahmoud, for the question. First of all, this is not a matter of market share and competition and someone taking something away from each other within the buy now, pay later sector. It's really much more about entering with our proposition into this huge opportunity, which is only covered as a fraction so far. If you look at the percentage of business which goes through buy now, pay later. And if you think about what I do, that buy now, pay later has the potential to replace credit cards over time, there's a massive opportunity within Australia and in any other market to really tap into this opportunity. And from that perspective, we believe with our differentiated approach, as any competitor in the market with their footprint, there will be ample growth opportunities in Australia and our home market, but also in any further market which we will enter. So from that perspective, for us, from our perspective, really blue ocean to make this the most prevalent payment option going forward globally. Let me see what other questions we have. A good question which I like to address from an anonymous attendee. Thanks for the insights to Q4, Michael and Andrew. Can you perhaps give us an insight trends whether repeated users in UK have tendency to use Openplay platforms in each of the verticals? Is there a percentage as a high-level overview? So first of all, to reiterate that message, so far in the UK, we focus on retail online to start with. We have found that this is the fastest way to scale quickly, to become more attractive to merchant in merchant acquisition with a higher number of consumers using our product. And from that perspective, in the UK, we don't know yet what the take up in other verticals will be, as we haven't launched into them. But what we see now increasingly and repeatedly in Australia, where we've been in the market across verticals for a longer period of time, particularly around Openpay, customers are very, very receptive to direct marketing, which offers them some really relevant, unique business or purchase opportunities, if you like, for other verticals than where they have maybe started their journey with Openpay. So we believe we can replicate this very successful kind of cross-pollination model to bring consumers from one vertical to the next and become their partner of choice of managing their lifestyle needs financially over time in the UK as well. Next question, when will you be releasing the yearly results? We are working through the process to get our financial metrics audited, as you would expect, and we will come back to the market and the ASX with our year-end results in around a month's time, or a bit more, end of August. I take a question from Kelly McElvey. Do you see Klarna as a risk? If not, why not? Thanks, Kelly. First of all, again, this market is huge and the market opportunity massive. And we believe with our differentiated approach, there's great opportunity for us to grow in our own right with our own focus. Klarna, if I look at them in the UK and now recently also in Australia, probably address the needs of a more younger audience. In the UK, they've been growing strongly on the back of a try now, pay later product, which is more purchasing in fast moving fashion and then starting to repay, including a first deposit only after some time. This is not what we do. As you know, our responsible approach from that perspective asks our customer to pay 20 to 33% of the purchase value right away. This is how we believe we can create intent. And I think this is particularly helpful for merchants because return rates typically with our product go down and do not increase. But again, Klarna have done an amazing job in every market they have been. And we believe with our differentiated approach, it's not a risk or a concern for us, but more helping the broader proliferation of buy now, pay later across the globe increasingly, where competitors and other providers of buy now, pay later enter the market with their respective proposition. I take a question from Ayush Gupta. Apart from Woolworth being your first B2B client, any other clients in the pipeline at the moment? Yes, indeed. Thanks, Ayush, for that question. Typically, when you look at such a highly complex product like B2B, which requires an end-to-end integration with the customer, which our platform, our SaaS model can do much more easily than any bank's transaction banking offer. It's nevertheless quite a project for enterprise retailers to do so. So what we have been very excited about is now getting towards the end of our integration with Woolworth to really then kind of hit the market for other enterprise retailers and their business customers to see how it effectively works. And we are already in progress conversations with a number of enterprise retailers in the UK and in Australia particularly. But I think it's really over the next few months to see how it looks like for other enterprise retailers on the back of Woolies launch, and then I'm sure we will see more deals coming through and agreements signed over the next half year. I take a question from Amil. Is Openpay looking to acquire or merge with any other buy now, pay later platform? Thanks, Amil. And probably you refer to what we have seen in the past with Afterpay acquiring ClearPay in the UK and Zip QuadPay in the US to kind of prepare for their market entry. We currently don't have active plans to acquire other buy now pay later companies, but what we continue to do, obviously, focus on our own growth strategy, and we believe with our, in my view, strongest technical platform in the market, which allows us great flexibility to enter new product areas, to enter new verticals, to also connect and integrate with other platforms, what we are now proving with Pentana and recently the first group in healthcare. I think we can grow and continue to enter new opportunities in our own right and based on our own platform and product capabilities. However, never say never. If there's a compelling opportunity which makes sense strategically and adds to our strategy, we would not exclude this going forward. I take a question from Tim McCraner. Thanks for the presentation. Where do you see the share price over the next year? Thanks, Tim. That's a bit of the crystal ball. And to be very, very honest, as long as we see a positive trend, I'm fine. As management, I focus not on the share price, I focus on the core of the business, on executing against our strategic promises and continuing to delight our customers, consumers and merchants with the ease of integration, the compelling kind of opportunity for them to improve business and for the consumer, their way to manage their budget smartly. And I think the share price is following the great work which we do and the results which we deliver continuously and consistently. So the focus for me is really on delivering outcome, and the share price will follow. I scroll through the increasing number of questions, and some of them we have, many of them we have covered already. I take a question from Roshan Basnet, because it's a bit of a controversial one, so keep it interesting. Most of the Australians still do not know the Openpay and its product. How can we approach to them? Thanks, Roshan. I think looking at the recent study, we have seen that the awareness of Openpay as one buy now pay later provider, amongst others, in the Australian e-commerce market has increased from 5% in 2018 to 80% in 2019. So we definitely seen an improving trend in awareness of consumer customers over time. And we are not far now from our two main kind of partners, if you like, or competitors, if you like, in the market, Afterpay and Zip, who have rates of 95 and 90%. But as we continue to grow into new merchants, but also through direct marketing into our existing customer base, and people are excited to come back and probably talk to their friends and family about this opportunity to be smart in managing their budget, I think we see an increased awareness of our product. And I'm quite positive about the trend in the past, but you're right, there is definitely more, and we would want to get above 90%, where our two main kind of competitors are already. I'm just scrolling through further questions. I see a lot of similar questions to what we have already. I take this one from Benjamin Mulligan. Thanks, Benjamin, thank you for your information. Do you have any data or plans to integrate into small business markets in the service industry, such as plumbing or building services, or payment software such as Xero or QuickBooks? That's a very good one. And indeed, for us, being one of the two providers, for instance, at Bunnings warehouse and kitchen as well, we probably have already a number of business customers who use us through the same kind of bank account and debit or credit card, which they use for their, if you like, private kind of purchases. So I guess we have a fair share of small business customers using our product already. But it's definitely an opportunity, as we are already now entering the B2B space with our software as a service solution, starting at the big end of town with Woolworths and probably other enterprise retailers, to kind of extend from there into more the mid-market, as we also kind of extend from buy now, pay later consumer into buy now, pay later business. And I think these two will exactly meet in the middle, as you have described. No concrete plans yet, which we would announce in due course, but this is for sure around the notion of integration and platform partnerships, an opportunity which we continue to investigate, and I guess we'll see some news in the course of FY21 to that point. From an anonymous attendee, in the near or far future, it is possible that buy now, pay later platforms will merge and form one or two big players in that vertical. It's a very good question. And I think the best way to look at it is looking at credit cards and credit card schemes over the last 50 years. And what we ultimately have seen is a kind of, first of all, a global proliferation of this type of payment, which I believe we will see with buy now, pay later as well. And then probably 3-4 big players like Visa, MasterCard, Amex, plus Diners and UnionPay, some smaller ones, who have kind of either been global or having covering a substantial niche. I think with the differentiated approach and also kind of the specific profile of consumers which resonate with which our profile and offer probably resonates more than with other players. I think that's a great opportunity for consumers to appreciate differentiated approaches, and I believe long term we will see a number of players in the market, some global ones and others covering interesting niches. I don't believe that there will only be two over a longer period of time. I have one for Andrew, for me pausing for a minute, from Leslie Leung. Thanks, Leslie. It's great to see that net bad debts as a percentage of TTV decreased significantly in Q4. Well done, team. What will be your top priorities in FY21, and what operating targets do you set to the team from a probably more financial perspective around this one? And Andrew, over to you.
Thanks, Michael, and thanks, Leslie. The top priorities that we have for the team, if I focus from a financial and risk management perspective, we're looking to optimize our risk management strategies. 2.9% in the current quarter is a fantastic result. We see that on the back of the implementation of some additional enhancements with our automated risk management system, as well as the integration of some third-party fraud solutions. We would expect to continue to improve and optimize both our credit and fraud risk management activity throughout the next FY21 period.
Thanks, Andrew. And there's another one for you from an anonymous attendee. Does Openpay carry the risk for bad debts, or is it shared with merchants?
No, that is part of the product. So Openpay does carry the risk for the bad debts. That's why we've got so much focus and drive towards identifying and optimizing our credit management and our fraud management schemes.
Thanks, Andrew. I see two questions around a potential second wave of COVID-19 in Australia, which may impact our business. And if so, what measures will you take to counter this second wave? Thanks, AJ, for this question. We are absolutely prepared and monitoring very, very closely what happens around us and in Australia and the UK. And we are very aware that a second wave may come in, and we will see to what extent. But I think the recent example of Melbourne lockdown shows it's not over yet. I think we have done at the beginning of the kind of first wave of COVID-19 in March, we have kind of responded very swiftly to what we have found. First of all, getting it really right for the consumer with regard to financial hardship, coming up with a flexible kind of payment deferral opportunities for them to not incur personal stress kind of in that sense. And I believe also on the flip side, tightening our credit rules to keep our overall kind of credit risk portfolio in a healthy spot and avoid hardship calls for the customer has been a second measure, which we'll continue to apply as we see things get worse. And we have the flexibility, our own IP on our platform, to change and tighten credit rules intraday if required in a very targeted way. And from that perspective, we are well prepared to mitigate these upcoming challenges again. But again, key priority for us to be available for our customers also through different difficult times on the merchant side and on the consumer side, but in the right way. Just browsing through, I think we have covered most of it. One question, will you be considering raising capital in the near future? Thanks to the anonymous attendee for this one. We've been in a very favorable position recently on the back of very strong May results and kind of communicating to the market that we had secured our first UK debt facility to kind of opportunistically raise 33.77 million Aussie dollars in early June. We had taken this, and this maybe adds to a question why we haven't gone broader at the time and also included the retail kind of investor base into that capital raise. And it has been, as we said before, on the back of a very strong inbound interest from institutional investors, which we took the opportunity to leverage and to raise capital in a very swift process. And this means we have now a runway of 10 quarters, if you take the ASX kind of calculation rules for cash run rate, 10 further quarters from here to be cash funded. So there's no immediate need for us to go back to the market and raise more equity. And we will see what happens further down the track with any upcoming kind of discrete opportunity, which may change this view. But we are extremely well funded on the cash and on the debt side, and there is no near-term further equity raise to be expected. A question for Andrew, also an important one from an anonymous attendee. Hello, we see in the reports that net operating cash flow is negative. Will this improve as receipts increases over time, or is this a structural issue? Andrew.
Thanks, Michael. Yes, it will certainly improve as the receipts come in over time. What you can see in the 4C, we had 15.75 million of cash outflow from an operating perspective. Of that, 9.25 relates to the timing differences between receipts from customers and our payments to merchants. So that part is all funded through cash or through debt. And as you'll see, the operating cash outflows will reduce as the receipts continue to increase with the growth of the business.
Thanks, Andrew. I take a question from Mark Sumich. Thanks, Mark, for it. Can you say anything about the typical demographic profile of the average user and whether Openpay is able to make a clear space for itself in the buy now, pay later market? Starting with the second one, we believe, and on the back of the differentiated approach across product availability across industries and targeting maybe a different consumer customer base. And this leads to the first part of your question around the typical profile. Look at our kind of distribution across the age cohorts from very young Gen Z to the other end of the spectrum. We have a quite nice kind of distribution from very young to older people. Probably our sweet spot from a consumer customer perspective is from an age perspective between 24 and 48, where the majority of our customers, around more than half of them, really are. And I think from a profile perspective, according to our availability and where people really like to use us, around areas of lifestyle which matter for a bit more older people also, our average customer age is around 39, which is older than our main competitors. And they use our product to be smart. They're finance savvy. They spread payments over time, kind of along their income or salary payments. And that's kind of probably where we focus on, where we have a sweet spot, a quite broad sweet spot, which suits our product and our growth really well. I look at further questions.
We do have a question from Danny Eunice.
Okay.
How are the first 2 weeks of July trading, continuing the momentum on from May and June?
You take that one?
So Danny, thanks for that question. And yes, I can confirm we still see the continued growth in our active metrics as we move through into July. And as indicated earlier from Michael, we're seeing somewhat of a resurgence in the last part of June in relation to the plans activated through auto and health, which is very pleasing to see, with some of the restrictions being reduced a little as we see COVID-19 changes within the economic environment.
Thanks, Andrew. And jump in when you see further questions also on the financial end. I have two more. Do you think Openpay has the potential to reflect the growth of Afterpay in Australia through its B2B focus? Not talking about our competitors, but I think the flexibility across offering buy now, pay later into the consumer and into businesses, kind of now what we do with Woolworths, I think provides us with a unique opportunity to take a much broader market opportunity than retail only, which is big already. But when we talk about B2B, we talk about a multi-trillion business in Australia and in other markets. And for us, it's really a unique opportunity, which we are at the beginning of with launching with Woolworths now. But I think we can capture a substantial share of that market of B2B, of wholesale and tradey business in the course of over the next years. And kind of strengthen our footprint in that part of the opportunity very, very strongly going forward, particularly as there is much less competition, if you like, than in the consumer space.
So Michael, just a couple of follow-ons from Danny.
Yeah.
So gross revenue yields fell from 11% to 9%. In relation to expansion from the UK and the retail focus. Is this likely to normalise or improve over the longer term? So Danny, as we look at that, 9% is still a very strong gross revenue yield, and it's well within the expected range between 9 to 12% of what we look at within our product mix. So very happy with the results as they come through based on that product mix of our verticals, plan lengths, and average transaction values.
Thanks, Andrew.
Second question from Danny is, with respect to new verticals and various soft launches currently in play, when can we expect meaningful total transaction value or revenue contribution? Is it more likely in the first quarter 21 or later in the year?
I can take this one. Thanks, Andrew, for calling it out. I guess looking at sports memberships, which is the first vertical which we have soft launched into, probably substantial result will rather follow in the second half of FY21 by the nature of the fact that with lockdown, this business has still not obviously gone back to the numbers which we have been seeing before. However, in education, I think we will see an increase and a strong kind of increasing part of our overall TTV in education a bit earlier. And we see already very encouraging uptake, particularly for online education. So I think there's a big opportunity in the course of the first half into the second half. And we have some large players in that space who we are talking with, who then would accelerate this trend. I would take one which I find interesting to think about and answer. What are your thoughts on Afterpay's announcement regarding Apple Pay and Google Pay integration? It seems that is the new trend. First of all, not commenting directly on what to the specific case. But I think that's what we have now seen over the last years. And I think with an accelerating trend, buy now, pay later becoming available through new and different ways for consumers and merchants to consume and use and benefit from. And I think the kind of in-payment app, if you like, integration of buy now, pay later now in this example into Apple Pay and Google Pay is just one more opportunity for consumers ultimately to use it. And all this, I think, is very exciting because it accelerates the proliferation of buy now, pay later across any markets and kind of also customer circumstances wherever they are and whatever way they prefer to pay for their purchases. They find buy now, pay later available at checkout, if you like, at point of sales. And I think this is, from that perspective, very, very positive that we see kind of increasing innovation in that space. And we obviously also continue to kind of increase the opportunity to be available for more of customers for more at more places where they want to purchase and use our product. And very interesting to see what happens in the market, and we are part of it, which is exciting. Good. I think that's probably, if I go through, Andrew, you may have another one, but from my perspective, we have probably covered most ground. Is there anything what you want to cover?
No, I think that we've addressed all of the primary questions, or most of the questions as we've been going through.
Excellent. So to conclude, ladies and gentlemen, thank you very much for joining us on today's call. Andrew and I look forward to updating you on our progress again soon. As always, if you have any further questions, please contact our investor relations team or reach out to me directly. Thank you very much and have a good day.